it's actually, there's a few different sampling types of problems, but this one is, this is probably the most tested one. The stuff that's in this one is the most tested on the CPA exam. In the past, I should say, it has been. So whether it will be in the future, I'm not sure. But in the past, these have been some of the questions, the type of subjects in that they test. So that was kind of the whole reason for doing this one. It was sort of taking those questions that were tested the most and kind of putting those into a handout. All right, so I think we talked about some of this stuff before, but the general purpose, the purpose of sampling, we talked about. I think we talked about this before when we did the classical sampling. Is you take a small sample and then you project it over the entire population, and you do that. You can do that for a couple of reasons. One is it's much more efficient, and you can get pretty accurate numbers a lot of times by taking a small sample. So if you have 1,000 items, you might be able to get in the 99 percentile by looking at 100 of them. And if it's expensive to do the testing, is it worth it to go through all that extra expense for 1% assurance? So it could be much more efficient to do sampling. There's also sometimes it's just impossible. And I look at like nowadays with this, the COVID vaccine, they take the vaccine, they test it on a certain number of people, and then from that, they whatever number of people they have, and they project over the entire population. It'd be impossible for them to give to test the vaccine on every single person on the planet, all 7 billion people, or it'd be impossible. So they have to do it by taking a sample. So as long as taking a sample, it could be that it's more efficient, or it could be that it's not possible. And there are things in business, I think I mentioned before, if you were to audit 100% of Walmart's inventory, would be impossible. There's not enough auditors in the world probably to do that. So, what do you do? Well, you take samples. And those samples you can use to get a very, quite a bit of assurance so that the numbers are what they're purported to be. That you can actually. I'll save it for later. But you can actually corroborate or refute the financial statements. But anyway, so first thing we're going to talk about is sampling and selecting a sample. And I'm sure you guys have probably gone through this in your sampling if you're at your statistics classes. But we're going through random samples are usually the best. And why? Why is a random sample usually the best sample?
It cannot be manipulated. All the subjects are individual.
Yeah, exactly right. It's what you said is actually is perfect. The term that they'd probably use would be unbiased. But and that the sample will have the best, if it's random, it's more likely to represent the entire population. So there, again, like you said, it removes a lot of biases that might go into the calculation otherwise. And so because it's unbiased, it's the best estimate of what the entire population is. So usually a random sample is the best. The next best, say, second best, you got a camera that sits there, blocks my screen. Okay, is systematic selection, and that's when you pick every nth item. Example. Oops. Example. Yeah, you picked every nth item. In other words, for example, every 10th item. So you go through and you say, okay, I'm going to take a sample. It's going to be, I'm going to pick 1 out of 10 or 10% of the population. I'm going to go through and pick every 10th item. And while there might not be any intentional bias in this, there is a problem in that there might be some kind of a problem with the invoices that shows itself every 10th item or doesn't show itself on the 10th items for whatever reason. So it is possible that you could have some kind of a bias, again, not intentional, but that it could be that every 10th item is, for whatever reason, is not it does not represent the population as a whole. So while it is, I would say it's free of intentional bias, it is possible that it has other bias in there that's built into more along the data itself. But there are audits that I've seen audits that say take every, every 20th one or whatever. That it's not that unusual, but you gotta be careful that there isn't. If you do use this method, be careful that you're not unintentionally missing some kind of a attribute or whatever it is you're testing. Okay, these last two are what I would consider the not good ones. Haphazard selection. And this is when you simply grab a selection from the population. So they'll say a drawer filled with files, you close your eyes and you pick 10 items out of the drawer. So you can imagine what might be some of the problems of doing that. So let's say you have a drawer that has a file that has all of the contracts with the customers. So you close your eyes, you grab 10 of them out of the drawer. What might be a problem?
Those 10, if they're related, might have the same, may or may not have a
kind of cut off there. Cut out on my end. You don't know if you are grabbing, if you're reaching in there, the ones with the bigger files maybe have a better chance of getting picked, and there's all kinds of things that go into it. Another thing that is a problem is if you pick a random sample, and a random sample usually you have either not random. random number generator usually in Excel, or if you use a random number table. If you have a printout that has random numbers that you're going to test, anyone can take that list, that randomly run a random number generator list, or the numbers from the random number table. And they say, okay, go pick the files from this list. And you can do it. And someone else can pick the same list and they'll pick the same file. So if the first file is 0278, you're going to pick 0278 or whatever it is on the list. So it's repeatable. And it's repeatable, and it'll get the same result. The judgment of what the result means might be different, but it'll get the same result. So if it's a random number and you're using a random number table or a random number generator, a printout, someone else can take it and get exactly the same result. Same thing with this one. Say pick every 10th invoice. So they say, okay, start with invoice number 7 and pick every 10th invoice. So you go, okay, so I pick invoice 7, I pick invoice 17, I pick invoice 27, 37, so on. Someone else coming in will pick the same numbers. Start with number 7. Every 10th, okay, 7, 17, blah, blah, blah. Okay, so these are repeatable. This one is not. If I go in and grab a sample, close my eyes and grab a sample, and someone else comes in, closes their eyes and grabs a sample, it would be fairly unusual if it was exactly the same sample. So part of the problem with the haphazard selection is that it's not repeatable. There may very well be biases built into it just because of whatever it is you're grabbing, randomly. You're trying to grab randomly, I should say. And so, for those reasons, it's not a great one. Actually, I did a haphazard sample that I'll tell you about in a few minutes here. So haphazard is generally not a good one. Okay. Block selection. This is when an entire block of an entire population is a sample. So, example. So we're going to test sales. We say, okay, we'll take the sales from October. And we're going to use the sales from October to project over the entire population. Okay. Well, first of all, does that sound like a good idea? Do the October sales, is that, are they usually representative of the entire year if you're talking about sales of, is that?
No.
No. A couple problems with it. First of all, it'd be unusual, let's say, a very stable company or business you're auditing, that that the sales are exactly the same every month. It's possible, but usually it's not the way it goes. And also, even more concerning is that it, unlike the other three, it completely eliminates the possibility of a vast majority of them being picked. If it's random or systematic, theoretically anyways, anything could be picked. Systematic, depending on which one you start with. You start with number 1, 2, 3, 4, whatever. You can have a random start, and no, haphazard, not the best, but I mean, theoretically, if you're picking them out, any one of them could be picked. Block selection, if it's not October, it's not going to get picked. So if there's a problem in December, There's zero chance of it being found. So block selection has it. Now, block selection is repeatable. It's got that going for it. That anyone can go and pick the October sales, but it's not a good way to do it. It's probably the worst way of doing it because it eliminates so much of the. Now, there's a saying that block sampling is for blockheads. And not to get too emotional about it. But. Okay, so these are usually the methods that they will use for taking a sample. I had one of the strangest. Probably it's about the strangest thing I did is. When I was auditing for U.S. Steel, this is in Gary, Indiana, and they had these huge buildings that were empty because they used to have, before computers, they used to have legions of clerks and stuff, right? Doing invoicing and all this other stuff for selling steel and buying iron ore and paying workers and all this stuff. So they have these huge buildings. So if you wanted space in the building, there was no problem. Tons of it. Some of these places are huge. They would be the size of you could play football. So I go to this building and they're doing invoicing for steel. It's called secondary steel. It's probably not important, but they also had kind of this subgroup kind of called sort of odd lots that would be all kinds of different things. It could be the ends of coils, whatever it is. But anyway, these were fairly unusual. They were unique usually. It was leftover armor plate or something. Who wants that? They were anyway. So there was also billing for that. So I'm in this place and I'm doing it, and everyone is pretty much in this one room in this huge building. But everyone's in this room. It's big and spacious, big windows also. Okay, so in there, and then I start. Okay, I have to go to this kind of the odd lots section. They say, "Oh, that's down the hall." Okay, so I leave. So I go to the, I'm walking in huge place. I mean, I'm walking down the hall, and it's hundreds of feet, down to the other end, and I can hear people talking. So I go in there. And there's a lady in there who is obviously schizophrenic. She's talking to herself a lot, they're just going on and on. So I walk in and hi, and she just kind of looks at me, doesn't say anything, starts talking about something, not looking at me, and I'm a little freaked out. So okay, well, I'm gonna get my sample and whatever. I can't find anything. There's nothing nothing's in any order. She's just in there by herself. And I, I'm saying, well, I'm trying to find this sample, and she stares at me a little bit, says something, mumbles something, nothing. I mean, I did, So I go back down to the other group, and I was like, what's going on? Why? And I was really upset. This woman needed help. They said that she's schizophrenic, but that she wasn't taking her medications, and it was a union thing that they couldn't make her take her medications. Well, okay, all right. So, well, what do I do? So I went to my supervisor. Like, look, and she was working on it. See all these boxes all over. She's working on about 10 open boxes around her. So, and I would look through there, and I couldn't make heads or tails out of it. They were just all over the place. There was no order that I could discern of anything. So I go to my supervisor, look, I don't know what to do. And, it's a union thing too, so it isn't like you can just say, well, fire her, or you can't do that. And I said, so what am I doing? Well, you get these items on the sample. I said, look, if you want me to spend the next 6 months trying to hunt these down, I'll do it. But, there is no, I cannot tell any organization of how to find these. And there's hundreds of them, thousands of them. So anyway, my boss, okay, he said, well, if you can't find a pattern, then you can just use haphazard. He said, you know, it's not going to be biased because you're just going to go in there, grab the ones, write down the ones that you grab, obviously, and use those because it's not, it'll probably be random anyways, because apparently what you're telling me is that these are, it looks like they're random right now, but any box of them is random. So that's what I did. And I went and I you know, just went and pulled them out, and you know, I would go and tell her, okay, I'm taking this one, and she would nothing. Okay, so I go and test it, and I picked a big sample. It was probably 80 items, which is quite a bit for what we were doing. And the punchline is that they were perfect. I didn't find one thing wrong with any of them. They were absolutely done, you know, to the T, which was not even with the normal invoices. You always found something that was, you know, wrong here or there, or whatever. But they were all perfect. And if you kind of knowing a little bit more about schizophrenia, I didn't really know at the time, but usually people who are schizophrenic are very smart. And she was obviously very capable of doing her job. She did everything I saw was perfect. But yeah, it was a weird one. And but again, you know, that was just a matter of there was no way of doing a random sample, certainly. And you know, the numbering was not sequential in anything. So if you had to do every 10th item, you'd be looking around the same things you would for a random sample. But anyway, that was the only time I think I ever did a haphazard. Now, I did, because I was an internal audit where we look for problems. There were times that I'd open up a file and I'd look for the one that had the most like sticky notes stuck to it, the one that looks like it has the most problems, and then you go through that just because you're looking for problems in your internal audit. You're not necessarily looking for the whether it's material or not. You're actually looking to see if there's any way to make improvements. But yeah, it was the only haphazard sample I ever did. Was that? It haunted me for a while, and I guess the woman was she was retiring in about a year, and so they were just going to let her retire. And I hope that she retired. I hope she got on her medication and everything was okay. But that was the only time I ever had to do that. Okay, let's go to page 2. Stratification. Okay, so below is the partial list. They have 5,693 accounts. And we got the first 10 here, and we also have the last one. Number 5,693 is in there too, but there's 5,000 plus accounts in here. And looking at the first 10 accounts, which accounts of Shiva would you be most, that's coming up on the screen here. Get out of here. Which of the accounts receivable would be the most important for an auditor to verify?
5 and 6.
Yep. Why?
Due to them being such large amounts, the auditor would have to make sure if they're not, you know, just making up the numbers or whatever. Yeah,
these two are obviously the biggest one. You know, if number 3 is misstated, well, who cares, right? It wouldn't do you much good to go investigate number 3. You know, even if it's misstated, it really wouldn't matter. So 5 and 6 are definitely the two that you would want to look into most closely. So you might want to look at those most closely. Which is most likely? Which account is most likely to be a fraud?
Number 9.
Could be.
Because they're the exact same number, and it's just a repeat.
Yeah, it could. The number that they would probably say the most would be the round numbers. For some reason, when people do frauds, a lot of times they use round numbers. I know it's completely stupid, but that's one of the things that they allow to find. It could be, though, that they use the same number. They just put it right in. So that wouldn't be a bad one either. It could be a pattern. But yeah, it's very unusual. You look for numbers that, nice round numbers are a lot of times what they would be using. Again, it's amazing how many times it happens. But, they'll make a sale for $25,000 even. Well, sales they never come out to $25,000 even. They're always, $25,726, whatever it is. But yeah, it could be this one. I mean, it could be that someone, especially if you saw a lot of them with the same pattern, 111, 222, that kind of thing. That could definitely be something that if you see a pattern of them that isn't what you'd call a normal pattern, you could definitely be that they are using that as a method of kind of keeping track of it. Okay, so probably number 6, but it could be number 9, especially if you saw other ones that we like. You're looking for things that are that don't appear to be random. Okay, so stratification of a sample. So you have all these items in the sample. This is just 10 of them, but again, there's 5,000 whatever of them. So sometimes they'll do what they call a stratification, and it'll be a bit. Are these invoices? What are these? Oh, accounts receivable. So, for instance, any accounts receivable that's over $10,000, you are going to take all of those. Accounts receivable. Say 5,000. Let's go. 1,000 to 9,000. Okay, so between 1,000, maybe you take 30% of those. And accounts receivable between 1 penny and $999.99. Maybe you take 4% of those. So it is possible that you can take the ones that are most important and do 100% of those. The big accounts receivable, you do those 100%. And notice if someone is trying to really make the books look better than they are. A lot of times they will do it in a fairly large fashion because, you know, you can't just put an accounts receivable for $28 and expect, you know, if this one was fictitious, you're going to have to do a whole bunch of those to make a difference. So a lot of times they will have larger amounts and they're fraudulent. Not only that, larger amounts, a lot of times they'll be more likely to have errors. If, you know, this, we talked about this when we did the sampling, the classical sampling. If kind of 77,290, if there's an error in it, it's much likely, more likely this is going to be a bigger error than, you know, these other ones. So not only that, a lot of times the larger ones will be more likely to have the bigger errors in them just because of the size of them. Question on that? So stratification of a sample, and this is done, and so you would actually take 3 samples. The first one would just be taking everything. This one technically isn't a sample, so you'd be just taking everything and testing it. But you would actually get a sample for this, you know, which ones, a number of those, what you would have, and then another sample for those. You'd break it up into 3 different ones. And you'd have to do the statistics stuff on those too, but this one, whatever it came up to, you know, if you're doing 100% sample, whatever it comes out to be off, you'd be pretty confident in that because it's 1-to-1, right? I mean, it's everything. So if you come up with something off here, there is no projecting it. It's just whatever those accounts that are over 10,000, they're all off by whatever you come up with. Okay. Different kinds of sampling. Attribute sampling. Attribute sampling, this is basically yes/no test. These are binomial distributions. So you guys, right? If you had a sampling class, I'm sure they did this. And it's sort of like, you know, so yes, no test. So where you would have this is, for example, I may have already used this example. I think I did. But if you have checks for over $5,000, checks for over $5,000 must have 2 managers' signatures. So the approval must have 2 managers' signatures on it. This is yes or no. Does it? Are there? You know, so if you find a check that's over $5,000, does it have 2 signatures on it or not? No, not. You know, usually on the approval we're talking about for something the Treasury Department write the checks, but the approval, does it have 2 managers' signatures? Yes or no? And again, it's just yes or no. If there's 2 managers' signatures, it's a yes. If there's only 1 manager signature, it's a no. So a no means they're not following the internal controls. So these are yes/no tests. Oops. Now, those of you who've been in statistics, you know that those binomial distributions, are those fun or not fun? They are usually decidedly not fun. They can get really, really complex really quickly. Luckily, also in your statistics, we have the central limit theorem. And the central limit theorem says that all distributions I'm going to say all, I say most. Most distributions would become normal over repeated use. And that is that no matter what the distribution is, I'll do it on the overhead here. So let me take a binomial. Attributes. Well, let's take a coin flip. Could be heads, could be tails, right? Odds are 50-50. Okay, if you take two coin flips, it's possible that they could be heads and heads, right? Possible that it could be heads and tails. Possible that it could be tails and heads. And possible that it could be tails and tails. Now, if order doesn't matter, and for what we're doing, order doesn't matter, you know, the possibility of having two heads is possibility of having one head and one tail. If the order doesn't matter, then both of these would work. Possibility of having both tails. So you can kind of see this is already, you know, this after two flips, it's already sort of looking like a normal distribution. Whereas up here, it was just a heads or tails distribution. Once you even get to the second flip, it starts to have that bell curve. So when you do multiple, and it could be any distribution, most distributions, if you do them repeatedly, end up being a normal distribution, which is why in your statistics class, they beat up the normal distribution so much, because everything, if it's done repeatedly, everything ends up being like that. And for us, this is good because when we do our statistics on it, we don't have to go through all the number crunching binomial distribution we normally have. We can just do the normal distribution, and it's much easier to work with. Okay, discovery sampling. Discovery sampling is when you sample looking for a problem. Looking for a problem finds a bad way to say it. Yeah, I don't want to say it. Yeah, and it could be looking for, it's possible that it's an attribute. It could also be looking for a misstatement in the financial statements. And basically it is that the bigger the sample you take without an error, the more confident you are. All right, for example, and I'm just making these numbers up. Actually, it probably is a discovery one in the book. I should look and see. If you find 100 items without an error, maybe you are 90% sure that an error doesn't exist. If you get to 200 items without error, maybe you are 97% sure that it exists, and so on and so forth. So at some point you can keep testing to see up until what, at some point you're going to get up to the 99% level that you'd be fairly certain that it doesn't exist. So this might be a problem if you're looking for something like fraud. So someone says, oh, there might be fraud in this account. Well, you can do discovery sampling looking for it. And at some point, though, if you don't find it, now if you find it, hey, you discovered it, it's what you're supposed to do. If you don't find it, you can actually get to a level of confidence of how confident are you that it doesn't exist. So it's sort of like you're looking to discover something, but if you don't find it, there's basically a number. You can also have an error rate in there too if you want, but usually it's done to see if there is a problem in a certain population. Classical sampling, we did this. Mean per unit, ratio estimation. Oops. Difference estimation. So classical sampling we already did. Probably proportional size. I want to check something really quickly in the book because they may call it something different. You don't have it? Oh, wait, they do have it. It's called monetary unit sampling. Okay, they do have it. I'll only put the term of the book uses. You'll see it called both of these things. Monetary unit sampling or probably proportional size. And we are going to do this. So, yeah. So monetary unit sampling is a specialized auditing sampling method. It's a little bit quirky, kind of like the way I suppose sampling is always announced. It's a little bit quirky, but sometimes it can reduce the sample size significantly. I'm not typing very well today. And that might not sound like a big thing, but sampling testing is one of the more expensive things you do in auditing. So, if you can reduce the sample size, this could save not just a lot of work, but also a lot of cost to the audit. So monetary unit sampling, also known as probably proportional size. It's a specialized audit sampling method, and it's not that it's any better than the classical sampling. It's just that in some situations you can use a smaller sample. So I guess so. Somebody's better. If you use it inappropriately, though, it's worse than sampling. It's classical sampling. Okay, dual test, dual purpose test. This comes from when you let me give you an example. I don't know if I already told you guys about this. If I did, you can feel free to yell at me. Test controls. Suppose we need a sample size of 100 items. We do some classical sampling. And we need a sample size of 520 items. Dual purpose testing would say, okay, wait, since you already picked a sample of 100 items, to do the classical sampling, you only need to pick another 420. So you'd have dual purpose test. Oops. For 100 items would be considered a dual purpose. They go before for both of them. And then the classical sampling only would be for 420 items. And these look like different sizes. They are different sizes. I think those are all the same size. I don't mean to. So the dual purpose test would say, okay, well, if you have these 100, if you already picked them for the test of controls, well, when you do the classical sampling, just get 420 more, and that'll make up your 520 items. So there were dual. I don't know if it's that big of a deal. They do test. I've seen that test on the CPA exam, so well, it may not be that big a deal. It's kind of obvious, but okay. Let's go to page 4. What time is it? No, let's take a break. I think we'll take a break and then we'll start in on chapter 3. I think let's do that. So the whole purpose of this, one of the things about sampling is kind of break it up. So we'll stop on page. Save this as working. All right, and so next class we'll pick up on page 4, problem 4. So let's. Ooh, it's all blurry. Let's go ahead and take a break. Let's say we'll be back at. We'll be back at 7. How about? And then we'll start in on chapter 3. Chapter 3 is a huge one, by the way. I know just what you guys wanted to hear, but it's there's a lot. Okay, and so we will. So this one, is there one that does not have the chapter 3 handout? Or did not get it? Okay, so when we come back, we'll go over that one. Okay. So the next thing we're going to do is go into chapter 3. And chapter 3 is about, it actually is usually broken up into 2 chapters. There's a chapter on audit planning and there's a chapter on evidence. They have them both in the same chapter. So it's a pretty big chapter. So we might be on this one for a little while just because there's so much in it. A good chunk of the CPA exam comes out of this chapter. But the first thing we're doing is going through accepting a client, getting a new client, what procedures you do to go through to get that, and planning the audit, and then comes the evidence, which again is usually a separate chapter, but they have it in chapter 3 together. So not to dishearten you, but we're going to probably be on this one for a little while. It's good stuff, though. There's a lot in this chapter for this good stuff to know, and a lot of it is test on the CPA exam. A lot of the stuff comes out here. The first one is getting a client. One of the things about auditing is that the only thing we lend to the financial statements is credibility. That's it. Credibility. So that people can rely on the financial statements. They look at the financial statements and they go, oh, these, it has a stamp of approval. So credibility is the only thing that we are really, selling or adding to the process, that the credibility of the CPA firm. So the biggest thing you have to consider when taking on a client is the client's integrity. The AICPA will tell you that you cannot be associated of people with ill repute. So it's different than being a lawyer. A lawyer, you can take anybody. A CPA is generally prohibited from taking people on as clients they can't trust. And if you think about it, even if you audit to the 99% level, if there's someone you can't trust, you really have to audit at 100%, which kind of defeats the purpose of sampling and all that kind of stuff. It becomes extremely expensive when you cannot trust somebody. I think the Enron audit, it cost, $5 million or something like that. When they found that there was all kinds of fraud, the next audit was $200 and some million because they had to go through everything. So, when you're deciding to get a client, the biggest thing is their integrity, and that and this is something that a lot of clients don't understand, is that it's not like McDonald's where you go in and everybody who goes into McDonald's can order whatever. They hand it to you and you walk out the door. It's not like that. So you have to be very careful about those people that you take on as clients. And not only that, people of ill repute are more likely to get into trouble. That's usually why they have a reputation or have had problems in the past, is because of that. So it also heightens that risk that you don't want when you're doing an audit. So as we go through here, that even though we'll go through it, there's a number of different things in there. But the biggest one that they're going to talk about on the CPA exam is that you do not want to be associated with any client that lacks integrity. Okay. And again, part of the reason is we give credibility to the financial statements. If you're associated with people that are, it hurts that credibility. Okay. I don't know what I did with it. Try something different. I can't find. There's my document. Okay. All right. Anyone that does not have this handout, that needs it? Okay, it should be in your email. If it's not in your email, it is listed in Blackboard. Okay, so you're thinking about taking a client. The first one is your CPA firm, is it qualified to do the audit? You know, do you have the experience necessary? Okay, so for example, suppose that you're contacted to do audits of a what do we meant 2 words? So let's say there's a large out of a large laundromat firm. They have all these laundromats, and you're come to you, they want to get an audit done. Now, you've never done audits of laundromats. Can you take it? Yes, you can take it if you believe that you can get enough experience or information to complete the audit. So and by the way, if you think about it, if you don't have any clients that are laundromats, why would you become an expert in auditing laundromats until you get a client? So you can take on business types that you're not familiar with, as long as you are reasonably certain that you can get the expertise necessary. It could be through research. It could be through bringing in an expert. You know, if you don't know how to audit laundromats, find someone who did audit laundromats, and bring them in as a consultant, and use their knowledge. So you can take clients that you don't have experience with, as long as you are reasonably certain that you can get the experience necessary. I thought that was one word.
I think you meant like laundromat is one word. The laundromat is separate.
What is it? Laundromat?
Laundromat.
Oh, OMAT? OMAT? Yeah, that's. I capitalize it. Is that a firm? Or is it a? In hindsight, I should have chose something else. Donut shop. That's what I should have chose. Something I could spell. All right. Okay. So does the CPA firm have the experience to complete the audit? Even if they don't have the experience, it is possible for them to take the audit if they're reasonably certain that they can get the background that they need to complete the audit successfully. And again, it could be doing research, it could be bringing in experts. However they get their information that they can do that, that's fine. And again, why would they become experts in doing laundromat audits if they don't have any laundromat clients? They wouldn't. Okay, so is CPA firm qualified? But this next one here is also very important. Can the audit be completed? It is possible that you think you could do the audit, or maybe you even have experience doing the audit, but for whatever reason, you don't think that it can be completed. It could be that the internal controls and the organization of the place is just too chaotic to make heads or tails out of. You could have other concerns. Maybe they had fire that took out all their accounting records and all that kind of stuff. So you also can't take the audit if you don't think you can complete it. So only if you can complete it, or reasonably certain that you can complete the audit, should you take it. So again, it could be that from your experience that you don't have the experience, you don't think you can get it. Then you say, no, we can't do that. But it could also be that for whatever reason, something that is with the client, they don't have any accounting records, they don't have whatever it is, they can't get information. If you can't get enough information to form an opinion, you shouldn't take the audit. So not only is it, can you do the work, but also can you get the information? And if you can't get enough information to form an opinion, you shouldn't take the audit. Okay, legal and ethical requirements. The big ones here are independence. And that is no financial interest. And no key person problems. So the big one is, let's go back to the laundromats. It's possible that someone is who say works in the CPA firm, maybe their mother is the CEO of the place, CEO of the laundromat. Well, you can't take that. The CEO is a key person. It's a close relative. You can't do it. So it is possible that, this doesn't usually happen for publicly traded companies, but no financial interest. If you have a local hardware store that needs an audit, and if it's a local CPA firm, you may have somebody working on your staff that maybe is a part owner of it. Maybe it was established years ago and it's a family business and they have 10% of it. You can't do the audit. So independence is a big one as far as what you can't take. There are also some other circumstances that you may kind of. These are sort of usually conflict of interest ones. You may be doing an audit for a competitor. It depends on the business and all that kind of stuff. But if you're doing an audit for a competitor and if it's basically between the two different clients, you could run into a conflict of interest, and that it might look as if you're favoring one, or they may even get nervous that you're giving information about one to the other. even if you're not. And again, we have to be independent in both fact and appearance. So conflicts of interest, audit, where'd that come from? Did you see that? I must have hit something. So audit for a competitor. That's kind of neat. Okay, it could also be lawsuits. It could be one of your clients is suing the client, or vice versa. So sometimes you never, you have to kind of get the full picture before you figure out whether you should be able to take this or not. Conflicts of interest a lot of times can come up, whether it's you audit a competitor, there's lawsuits between the competitor. It's happened where there's been lawsuits against the CPA firm, or the CPA firm against the client, and if you have these lawsuits, it's a conflict of interest. So you gotta be careful when you're doing this stuff. Okay, good question. All right. According to the ACCPA, this is the most important one. Integrity reputation of client, and that you have to be able to trust your client to some extent to do the audit. And so avoiding clients that are less than reputable is a very important part of whether you should take the audit or not. Okay. Well, if they had an audit before, when you get offered this audit, or you are pursuing getting an audit, taking on someone else as an audit client, you need to contact the predecessor CPA, and this is key. It's you're required to contact them before you take the audit. I gotta make some space here. Some terminology. Yeah. Okay, so here's the terminology that they always use. The predecessor auditor is the old auditor. And the successor auditor is the new auditor. So if you're if you're looking at this as a new client, you are the successor auditor. It's your job to contact the predecessor auditor. So the successor with the client's approval. So you have to get approval from the client to contact the predecessor auditor. So the successor auditor, that would be the new auditor. If you're looking for this as a new client, this would be you. Must contact the predecessor auditor, not the other way around. The old auditor has no responsibility to contact you. You must contact them, and you should do it before the audit is accepted. You must get the client's approval because this is confidential information. So confidential information is such that you need approval from the client to do it. Excuse me. Okay. Suppose you got a client that says, I don't want you talking to the old auditors. The old auditors were a bunch of jerks. And, you know, if you have to do more work, fine, I'll pay for it. But I don't want you talking to them. You know, those guys are idiots. And, I don't want you dealing with them. In that case, can you not talk to the predecessor auditor? So the client says they don't want you talking to them. And you know, maybe they're right. Maybe they were jerks. but is that okay for the client to say, no, I don't want you talking to them. I'm not going to give you. I'm not going to approve it, you know, for you to talk to them. The client tells you they don't want you talking to someone or doing some kind of procedure, whatever, you know, this is an audit procedure. If they don't want you doing it, you know, usually there's a reason, right? And so, and that's one of the things that you got to remember whenever a client tries to keep you from doing something that you need to do. It's sort of like if you had if they're investigating a murder and they come to my house and they say, you know, we look around your house. I say, yeah, you can look around everything, but just don't look in this closet, right? Don't look in the closet, but you can everywhere else you can look. Well, the first place they want to look is in the closet, right? I mean, that would be if someone doesn't want you looking there, that's your that's where the first place you want to look. Same thing with us. So if they tell us they don't want us talking to the previous auditor, now even more, we need to talk to the previous auditor. So, and again, it might be true that maybe the previous auditors were a bunch of jerks, but it's you still have to talk to them. And you can tell them, look, you know, I understand that, you know, whatever. I'll take whatever they say with a grain of salt and all that. Okay. So how do you get information? Well, information from the predecessor auditor. If they are an issuer, if it's publicly traded. If it's publicly traded, there's an issuer that they will have to file a 8K report with the SEC. And in this report, they will have so when they change auditors, they'll file this 8K report. By the way, the 8K report is not just for auditors. It's whenever there's a change made in the company, they got to tell the SEC. So if a company gets a new president, they got to file an 8K report. The 8K report says we got a new president. If they get a new chief financial officer, file an 8K. They buy a competitor, 8K. So anytime there's a change in a company, publicly traded company, they got to file an 8K with the SEC. But one of those things is if they get new auditors. And in there, they will have to disclose any disagreements with the auditors over the last 3 years. And by the way, the previous auditors will approve of whatever they put in the 8K. The 8K gets filed with the SEC. The SEC gives the 8K report to the auditors, and it's a yes or no. Did they tell everything that they had a disagreement with? Yes or no? If the auditors say no, they go back to the company and say, look, you got to tell us more, because this is not all the disagreements you had over the last 3 years. And they have to do it again. So if there is an 8K report filed, it means that the previous auditors had agreed that whatever's in that report is complete. And the disagreements over the last 3 years. Okay, so the successor auditor, you're going to contact the predecessor auditor, and the question is, well, what are you going to ask them about? Okay, well, here's the things you're going to ask them about. Integrity of management, number one. What do you know about management? Can they be trusted? Are they honest? What's going on with them? So the integrity of management is the number one question, really, is what kind of a client are they? Second one, reason for the change in auditors. You'll ask them, in their opinion, why were the auditors changed? Why are you no longer the auditors for XYZ? By the way, in the 8K report, the company does not have to explain their decision. So you won't find in the 8K report why they changed auditors. It'll simply be, we changed auditors as of this date. The old auditors were these people, the new auditors are these people, and that's it. So they don't give the reason why they made a change. So you're going to ask the previous auditors why they're no longer or in their opinion, maybe why they are no longer the auditors. Do they have any insight into why they're not the auditors anymore? So you're going to ask them about, why did they change auditors? Why aren't you their auditors anymore? Auditor disagreements with management. This could be in the 8K report goes back 3 years, but this could be going back 10 years if you wanted. Ask them what the disagreements were with management. And if it's not publicly traded, there is no 8K. So if this company is private, there is no 8K filed because the SEC has no jurisdiction over them. So disagreements with auditors could be for oops. Non-issuers. There is no 8K report. So any disagreements with management, you're going to have to ask them personally. What disagreements did you have with this client? You're going to ask them about communications with the audit committee or the board of directors. What was it like dealing with those? Do they seem like they're doing their job, or are they simply a rubber stamp for whatever the company wants to do, or what are they? So communications with the audit committee or the board of directors. In this case, this is what they call the positions of governance. I don't know how you spell that. These are the people that are supposed to be overseeing the company, and collectively you'll see these as the governance positions. And so the question is, well, how do these people oversee the company? You'll also ask them about related party transactions or unusual transactions. Related party transactions are for people who are generally employed with the company and they have transactions with the company. For example, the controller purchased land from the company. What could be a problem with that? So the controller of a company purchased some land from the company.
Wouldn't that also be like fall under conflict of interest?
Yeah. Yep. Yeah, definitely. You know, the question is, you know, is it an arm's length deal? You know, do you want, you know, are there indications that these related parties are somehow manipulating either what they're getting paid from the company, or it could be that they're manipulating the financial statements. It could be the controller purchased land at an inflated price to boost up the company to make them look more profitable than they really are. And, you know, so we never any of these related party transactions. There's a question of whether they're at arm's length. And to that extent, when there are related party transactions, it is the company is prohibited from putting that in the notes of the financial statements that these are arm's length transactions, because sort of by definition they're not. Yeah, you can run into a problem though if you have these related party transactions. It's not unusual. I will tell you that, you know, that especially in some of the smaller companies or smaller to mid-sized companies, you'll find all kinds of, you know, stuff going on, and loans to people for cars and all kinds of stuff going on. But related party transactions, you know, how big of a problem is it? So these are all things that you're going to ask the predecessor auditor. And again, you're trying to get a feel for what the client is. Now, here's the thing. So you get it. So you're supposed to talk to them before you take the audit. When you talk to the predecessor auditor, you're not asking them for their work papers usually. I mean, there might be a couple things you might ask for for referencing, but you're certainly not going to ask them for their work papers of how they did the audit. You're not going to ask. You're going to do your own audit. And the predecessor auditor is generally required to, let's say participate, but generally required to respond. The only real exception to that is if they haven't been paid. Basically, if they haven't been paid, they'll say, "No, I'm not going to release any information until I've been paid." You know, if they want information from me, they have to pay my bill or whatever it is. But for the most part, they're required to respond to the successor auditor. So that, you know, and this is a real important one. If they have, okay, so yeah, I'm going to add something here. Just occurred to me. Yeah, I'll go back. That's what I don't want to forget. Okay. Third parties. Sometimes you get information from bankers and lawyers and that sort of thing. And that's another thing that you would ask the client for permission to talk to bankers and their lawyers and that sort of thing. And again, if they refuse, that's a red flag. If they don't let you talk, if they won't let you talk to their CPA, previous CPA, they won't let you talk to their lawyer. Those are all red flags that you don't want this as a client, because those are people you have to talk to. It's required that you talk to their lawyer. You're not talking to my lawyer. Okay, well, I'm a client. That's just the way it is. So, but talking to third parties to see if there's anything that you should know about them, it could be any number of things. Background searches. There's companies that will do this. It could be a simple Google search, but it could also be a professional. And it could also be professional searches. And I've seen some of these, some of the professional ones, and it's amazing how much information some of these people can pull out. They're almost voyeuristic how much information they can give on different people, especially people that have been somewhat in public life, business-wise. So background searches, it could be simple Google searches. It could also be, Google searches a lot of times for articles and things like that, but it could also be professional searches where they actually they'll go through lawsuits, they'll go through a number of different lending transactions and all this kind of stuff. A more thorough search. It really depends on the client and your doubts related to that client. So background searches. Okay. Now, a couple things. If it's their first, this will be the last thing we cover. I take that back. We'll do client continuance because that'll take 30 seconds. If it's their first audit ever, will there be a predecessor auditor? That's right. No, your silence was perfect, because there'll be no predecessor auditor. Or as I like to call it, let's put it wrong twice. I did. Oh, I said it. Okay. So there's no predecessor auditor. There's not going to be an 8K report. There's not going to be anyone to talk to about management. So if there's no predecessor auditor, the background check becomes more important. And there actually is another problem, and this is a problem if it is the first year audit and if they have significant inventory. Okay, so let me show you the problem. Here's the income statement. Oops. You gotta spell income statement. Okay. The income statement. We have our sales. Put that in a moment. Okay, we have beginning inventory. I'm just going to make up numbers here. We have purchases. And those two together will be our available. Oops. What is that? 3,200? Okay, and then we have our ending inventory. Okay, so this is the most that we could have sold. the ending inventory is really what we didn't sell, right? So we're going to subtract that out, and that'll tell us what was sold. So the ending inventory is what was not sold. Let's say, and this will give us our cost of goods sold. $3,200 minus 700 is what, 2,500? Okay, let's say that the sales were I don't think they might know. Well, maybe they do. I don't know. Okay, so and this will give us our gross margin, our gross profit. Okay, so here's the sales. The cost of the inventory that we sold was 2,500, so our gross margin is 1,500. Now, looking at these items here, which item would be very difficult at the end of the year to verify? Look at all the items in this income statement. Which item at the end of the year would be very hard to verify? Oh,
Would it be sales?
Actually, beginning inventory. This one, we can't jump in the time machine and go back and take the beginning inventory. Here we are at, this would be like on January 1st. Let me just, I should put dates in. So, on one, we can get the ending inventory. Ruined it. We get the ending inventory. Oops. This one's fine. We get this one. Count the inventory at year end. We can't jump in the time machine and go back and do the beginning inventory. So there can be a problem with the first year audit, especially if the inventory is significant to the company, of verifying the beginning year inventory. And basically, when it comes to financial statements, this means that the income statement, you cannot give a clean opinion to. You can give a clean opinion to the balance sheet, because balance sheet's all at year end. You can get the year end. This isn't the problem. It's the beginning that's the problem. Now, you might talk to the client, and if it's not a pressing need to get this audit, you may tell them, look, we can come in and do the inventory, and then next year give you a full audit. And you can get a clean opinion on everything. But if this is significant and you cannot get that number somehow, that becomes a problem. Now, notice that's not a problem if there's a predecessor auditor, because they've already issued an audit report that they presumably looked at the ending inventory, and so you can use, that as a reassurance of what that number is. So this is a problem for a first year if they've never had an audit before. And again, if they have time, you may talk them into, look, we'll come in and do the inventory. It'll be a special agreed upon procedure. We'll do the inventory. Next year, we'll come in and do a full audit and, give you a clean audit report. But anyway, so the first year, it is possible that at least for the income statement and the related statements of cash flows, that come out of the income statement, that they don't get a clean audit for those, but that they do get a clean audit for the balance sheet. The balance sheet you can always do because it's all at year end. But the income statement is a tricky one because of that beginning inventory. Now, if it's a company that doesn't have significant inventory, maybe they have supplies, it's a consulting firm, and they, or whatever. If it's not material, we don't worry about it. If it is material, in this case, it would be, because it looks like that's what they're selling. this is probably their main source of income. So that would be a problem. Question on that? Client continuous is that every year you evaluate the client. So every year, the client needs to be reevaluated to continue with the audit firm. So there should be some kind of controls in effect to see if you want to keep them as a client. And it could be that there's disagreements or whatever that make the CPA firm want to walk away from it. Next class, I'll give you guys an article, a very famous article on a very famous law case that has to do with that. But basically, you don't want to get involved with a client that has bad reputation, but also know that if you're in the middle of an audit, it's very hard to walk away. That's another thing that is that. There's another thing that being a professional, you cannot leave the client in a worse position than when they came to you in the first place. What that means is a lot of times that if you're doing an audit, you can't simply leave an audit. So let's say the client is being unreasonable or whatever it is. Walking away from a client is very difficult because of the professional standards. And if you think about it, it's sort of like a doctor. Let's say there's a surgeon, and the surgeon thinks he's going to do a routine operation, opens up the patient. There's all kinds of problems in the patient. The doctor goes, "Oh man, I didn't expect this," and runs out the door. As crazy as that is, you can't do that either. So you cannot leave, basically a patient, your client, in a worse position than they were before. And especially for things like taking inventory. If you are an auditor and you're there for their year-end inventory and you quit, the next auditors that come in, they can't jump in the time machine, go back and do the inventory. So it's a very important, it's sort of like a leap of faith that you either take the audit or you refuse it well in advance so that they can get somebody else to come in and do the audit. You don't get halfway through the audit and then decide you don't want to do it. At that point, you're going to be looking at lawsuits, just like the doctor that ran out of the operating room. Same idea. But anyway, there's a famous case that I'll give you guys next week. Okay, I think we'll just stop there. The exam is due tomorrow. Yep. So then due tomorrow. So that'll be the only thing for next week. We'll stop right there for the handout.
I have a question. You have those clocks. What countries are those for? On the
yeah, those are not hooked up. That was what I got. This is my basement. I thought weird stuff in here. But yeah, those aren't hooked up, and they're not hooked up because I thought they'd be really neat. They're so loud. Yeah. So you can't run them. In hindsight, I should have spent the extra money and got the silent ones. And they do sell silent ones, but the reason why those that sit there and don't move is because they're so loud. So I'm not sure which countries they are, but time has stopped in those countries. Any other questions?
No.
All right. Okay. Well, so make sure you get the exam in, and it'll be then next week. We'll pick up. Probably finish the sampling overview next week. Probably will not finish the Chapter 3 handout. Any questions?
So the exam is the only thing that we have to do not next week, but tomorrow, right?
Yeah, and that and the multiple choices that we did last week.
Let me check and make sure. Do I have it? Did I put a drop in for those?
Yeah.
Yeah, I turned them in a little while ago.
Oh, okay.
Yep. It's those questions from the other chapter 2, and then the multiple choice and the exam.
Yeah. So so these are the only. Yeah, two. And by the way, they're due tomorrow. If you don't get it in tomorrow, I don't take off points. Your grade to date will look bad until you do turn it in, but by all means turn it in. I do take late work. I don't encourage it because it makes it, especially a course like this that builds. One thing builds on another thing. It can be a little tricky, but by all means, turn it in. If you don't get it in by midnight or whatever, turn it in next day or whenever you get it in. So, but yeah, it's due tomorrow, and again, your grade to date will look bad until it is turned in. But by all means, turn everything in. Any other questions? Okay. Well, I will see you guys next week. I do have office hours tomorrow at noon and at 6. Those are in Blackboard. You just click on them. Or any other time. If you need, if those times don't work, go ahead and email me and we'll figure out a time that does work. The only times I can't really do it are evenings. Monday through Thursday, I have night classes at 6. But I also have 2 day classes at Tuesday, Thursday at 11 a.m. But yeah, so night classes, I can't do them at night generally, at least not until after, say, 8:30 or 9. But yeah, most other times I can. All right. Well, have a good evening and a good weekend, and I will talk to you guys in a week.
All right.
Thank you. Good night.
All right. Thank you.
Bye.
See you guys.